Labour, it's the party of working people. This was the refrain from Keir Starmer and Rachel Reeves throughout last year's general election campaign. The two central themes of their pitch to make the economy better for working people was to drive economic growth and to end the Tory chaos of the previous 14 years by bringing security and stability to the UK economy, branded by Rachel Reeves as Securenomics. Now, the growth that was promised has not materialised as of yet. The UK economy did only grow by 0.7% in the first quarter of this year, and in April and May it shrank by 0.3% and 0.1% respectively. Now, monthly figures do not tell the whole story, but it is still a worry for Rachel Reeves, as this is far from the highest sustained growth in the G7, which was Labour's central mission during the election campaign. One of the key drivers of economic growth under the last Labour government was the finance sector. Banking liberalisation from the late 80s, known as Thatcher's Big Bang, gave the UK economy a boost in growth up until the financial crisis of 2008, after which tighter regulation was put into place to prevent such a crisis from reoccurring. In her quest for growth, Reeves is looking to scale back some of this regulation to create her own bonfire of red tape. She outlined her plans to financial sector bigwigs at Mansion House last night.
And today we can go further by announcing the Financial Services Growth and Competitiveness Strategy, including my Leeds reforms, named after one of the UK's great hubs for financial services, and the city that I have been proud to represent as a Member of Parliament for the last 15 years. These are the most wide-ranging package of reforms to financial services regulation in more than a decade. At Mansion House last year, I said that we must regulate for growth, not just for risk. We are delivering today on that commitment, while continuing to protect financial stability, so that the benefits of a thriving, growing financial services sector can be realised for people all over Britain. Let me set out the details of that package in 4 parts. First, I am rolling back regulation that has gone too far in seeking to eliminate risk. Second, I am delivering targeted changes in the areas where the UK already has particular strengths. Third, I am making changes to capital requirements to unlock more productive capital. And fourth, I am introducing measures to boost retail investment so that more savers can reap the benefits of UK economic success.
So are these sensible cuts to burdensome regulation or the basis for the Big Short Part 2 electric boogaloo? Yesterday in the Financial Times, Rachel Reeves expanded on the rationale for her proposals. Risk, like most things, can be good and it can be bad. It's not good for an economy to bear too much risk, as happened in the lead-up to the global financial crisis when bad lending built up, assets collapsed, and working families paid the price. The protections that were put in place in the years that followed were the right thing to do, with better protections for consumers and more accountability injected into the system. But more than a decade on, the pendulum has swung too far in the opposite direction, with an excessive focus across our economy on stamping out risk entirely. No other globally competitive financial services hub imposes such relentless bureaucracy on its businesses, and nor should we. This culture of risk aversion to the point of an obsession with stamping risk out in all of its forms is not an approach seen in any of our competitors. It is bad for business, bad for growth, and bad for working people. Now, I'm no banking expert, but this doesn't seem very securenomics to me. One of the biggest changes in the reforms is to tear up the ring-fencing regulation which separates retail from investment banking, initially set up to protect consumer deposits from the risk associated with investment banking, which was what led to the famous queues of consumers withdrawing their savings from banks that had gambled consumer deposits in investment markets and lost in 2008. The original ring-fencing regulations were hotly opposed by the big banks such as HSB, Santander, Lloyds Banking Group in 2011, and they have lobbied for their removal, to which Reeves will be consulting on in the coming months. Now, before the election, the Labour Party's financial services plans were drawn up with advice of executives of both Barclays and the London Stock Exchange, which may shed a light on who has the ear of the Chancellor. Those plans were also drawn up by previous City Minister Tulip Siddiq, who was replaced this year by Emma Reynolds MP. Last year, Novara Media ran an article delving into the backgrounds of Labour's parliamentary candidates with backgrounds in lobbying. At the time, we reported that Emma Reynolds was a managing director of a lobby group called The City UK. She's overseen public affairs as well as policy and economic research for the organisation, which describes itself as, quote, industry-led body representing UK-based financial and related professional services. Now, you don't need to be a genius to work out that having a city minister who is quite literally a lobbyist for the city, for a lobbying company called The City UK, might have a tiny bit of a conflict of interest here. She was confirmed by the Financial Times to be leading Reeves's review of both ring-fencing rules and potential reforms to the Financial Ombudsman Service, a consumer protection agency which the industry have complained as acting as a quasi-regulator. Good luck, working people. Luckily for us, the Treasury have announced they're helping people onto the housing ladder. No, not by bringing prices down, unfortunately, but by loosening mortgage borrowing requirements. The Treasury said this on Twitter earlier today. First-time buyers will be supported to get onto the housing ladder, with the Bank of England allowing more lending at over 4.5 times a buyer's income. This reform could help 36,000 more people buy a home over its first year. Now, it's worth pointing out that adding more demand-side subsidy, all it does is push up house prices. They've continually tried this. Government after government has sought to put money into the pockets of people to make it easier for them to get on the property ladder and to become a first-time buyer. And they've done it continually with demand-side subsidy. And all it's done, right, with things like Help to Buy, for example, is push up prices for housing whilst actually not making it that much easier for people to be able to get onto the property ladder. The people who this really helps, to just allow them to borrow more, to be closer to being a subprime mortgage holder, for example, or to have access to things like extra cash for Help to Buy or help with a deposit or no deposit in some cases. The people that it actually helps are the high earners who can pass a mortgage affordability assessment criteria, which is essentially based upon whether you can pay back a mortgage, which is entirely around your monthly income, right? It's those people with a high income, the Henrys of this world, who don't have the cash on hand for the deposit, who really get helped. Like, these are mostly kind of middle class, upper middle class young people who can usually get help from the bank of mum and dad anyway. This is a bad policy rather than what we should be doing if we really want to expand the access to housing, is build more social housing, more council housing to improve supply, to undercut the rental market so there's less incentive for landlords to want to just completely monopolize the actual housing stock, which will mean less demand and push down prices overall. Because lower house prices is the only way you'll help working class people onto the property ladder. Because even if you give them access to extra credit, even if you give them extra towards a deposit, they'll still not pass the mortgage affordability assessment criteria unless they have higher wages or the house price comes down. So these demand-side subsidy programs are not a good idea. There's the famous meme, you just need to subsidize demand, and it's a cycle that will keep on going. It'll keep on going unless we actually bring house prices down, lest, of course, we annoy the middle-class homeowner voter base that every single party wants to court every general election. The news this morning also wasn't good for Rachel Reeves either. Inflation statistics for June have just been published, showing an unexpected increase in inflation from 3.4 to 3.6%, almost double the Bank of England's target of 2%, potentially putting the brakes on future interest rate cuts, as well as squeezing the incomes of consumers. This will bite those on low incomes the hardest, as significant contributors to current inflation are transport and food costs, of which the poor spend a larger percentage of their income. The government will need to find solutions to this, and fast. Polster More & Common's Shatton Brittard report noted that half of the country believe that the cost of living crisis will never end, which is crazy to think, right? That there are huge swathes of this population that do not think they will ever see an increase in their living standards, that's not good. That's not a good position for a government to be in. In response to this, consensus amongst the population and the data from the US election showing that voters need to feel their life is getting easier and not just be shown it in data, some of Labour's backbenchers are sounding the alarm. Labour MPs asking for the Labour leadership to be more radical on the cost of living crisis. That's 104 MPs to be precise, possibly as a response to the successes of Zohran Mamdani's relentless focus on an economic agenda very specifically. And this is true, right? Like, there are basic stuff in terms of the way in which you approach policy. You have to look like you care, and it has to immediately be felt in people's pockets, right? So one policy that made no sense at all that this government did on coming into office was to reduce the subsidy for bus tickets. So the price for the bus tickets was capped at £3 instead of £2, right? These are the poorest people in the country, the people who Labour purport to want to be governing in the interests for. And whilst you can show that wages are increasing higher than they have under the Tories, which is true, increases in the minimum wage and stuff like that, these are nebulous figures that allow people to see a better ratio of income to cost of living. But unless you have policies that you can point to that directly affect people, like, I don't know, having more subsidy for buses, which, remind you, they cut those subsidies whilst keeping the freeze on fuel duty. So car users who are predominantly richer benefited from this policy, while bus users who are poorer saw their cost of living go up. And it was a deliberate choice by the government. And it saved them, what, £500 million? It wasn't worth it. And that has only led to more people feeling less hopeful about the government that's in charge and doesn't look like it has their interests at heart. Hey there, if you enjoyed the video, make sure that you like and leave a comment. That helps the video out in the algorithm. If you subscribe and ring the bell, it'll let you know when I go live. I stream every day on YouTube and Twitch. You can also follow all of my socials down in the description. And if you want to support me in a more financial manner, there's a join button for membership. It's just 99p to be a member on YouTube, as well as a Patreon, and there's some merch there as well. And hopefully I'll catch you on the next video. Take care.